What's up, everyone? Let's talk about options. We're going to start over from the beginning. I'm going to go slow. I'm going to go through all of the different strategies starting from the beginning, because if everyone would just slow down and start to learn the different strategies, there's a strategy for every situation. And the good thing about options is, by definition, they give you options to get out of sticky situations or to basically make money whether the stock's going up, down, or sideways. So let's go ahead and take a look. So first of all, what is options trading? An option is a contract that gives the buyer the right, but not the obligation, to buy or sell an underlying asset or instrument at a specific strike price prior to or on a specific date, depending on the form of the option. You may hear options referred to as derivatives, which essentially means that they are financial contracts that get their value, risk, and basic term structure from an underlying asset. That underlying asset can be individual stocks, bonds, or ETFs. When the risk and structure of options are understood, they can be a versatile investment tool that can work in both a bull market, rising prices and optimism, and a bear market, falling prices and pessimism. While the language and structure of options trading may seem foreign and confusing, just like the rest of the market is made on purpose, you've probably seen how option strategies work without even realizing it. Now, before we jump into the strategies, let's break down the basic terminology of options trading so that you can have fundamental answer to the question, what is options trading? So there's a few things you'll need to know. First, of course, calls and puts. There's two types of options, one that gives you the right to buy and one that gives you the right to sell. Calls is the first and puts would be the latter. A call is an option that offers the right, but not the obligation, to buy an underlying asset at a certain date for the predetermined price. Now, that's important to remember. It's the right, but not the obligation. So you have the right to buy those shares if it reaches in the money, if you bought out of the money, but you don't have to. You can just sell it and take your profit. Now, the other side of it's true as well. If you were selling the call, you're selling that right to buy shares, but not the obligation. That's all you're doing. You're trading a non-existent imaginary right that's basically nothing. That's what options is. It's all derivatives based on the underlying. A put is an option that offers the right, but not the obligation, to sell an underlying asset at a certain date for a predetermined price. So the opposite is true with a put. If you were selling a put, it would be basically selling the right, but not the obligation, to sell an underlying asset to somebody else, and at which point you would get premium up front. And whenever you see P&L, this is called a P&L chart, profit or loss chart. This is what the long call looks like, and this is what the long put looks like. And you'll see these next to every strategy, just giving you a visual. If you bought the strike price here, it's giving you a visual where your profits and losses would be. So your loss would be down here, profits right here for a call. So calls, loss down here, profit right here. You want obviously the price to be above where you bought it. Opposite's true for a put. You want the price to be lower than where you bought it. Now, strike price. The strike price is the price at which you can buy or sell the underlying asset if you choose to exercise the option, which, by the way, it's very rare that people exercise options. Rare circumstances does this happen. Expiration date. All options have an expiration date, that is, a date when the options contract becomes void. On the expiration date, the owner of the option has a choice. Elect to exercise the option or allow it to expire worthlessly. Now, in Europe, they only have the option to exercise on the day of expiration. In America, that's not the case. You can sell your contracts whenever you want. So if you're up 25%, but it doesn't expire until 3 months from now, you can still sell it. And if the opposite was true, if you sold a call and the price started to rise, you could purchase that right that you sold earlier back before you lose any money. Now, depending on the terms of the option, the expiration date can be days, weeks, months, or even years into the future. Premium. There are two components that make up premium, also known as the price of an option: the intrinsic value and the extrinsic value. Intrinsic value is the real, tangible value of an options contract. Let's take an example of a stock that is trading at $100. If you own a call option or the right to buy an underlying asset at a certain price with a strike price of $80, the intrinsic value of this option is the difference between the market price, for example, which is $100, and the strike price, which is $80. So our intrinsic value is $20. Now, not all options have intrinsic value. Using the example above, with a stock that's trading $100, a call option with a price higher than the market value would have an intrinsic value of 0. So basically what that's saying, in the money will have intrinsic value, out of the money will not. Hopefully that makes sense. Now, at the given moment, with the stock trading at $100, you wouldn't assign any value to the right to purchase the stock for $120. This is where the factors of intrinsic value come into play. So it's $120, but it's over the strike price. So now we have extrinsic value, which the extrinsic value of an option is also known as the premium value or time value of the contract. As those terms suggest, this component of the price is determined by fluctuating values such as volatility, which is market conditions and scarcity, and time until expiration, or theta. The extrinsic component of premiums explains why options with no intrinsic value trade at a price higher than 0, because that time factor gives them value. That's why you'll see options out of the money on day of expiration do not have value, because there's no time left and there's no intrinsic value. So if there's no intrinsic or extrinsic value, your price will be at 0. Now, how do you make money trading options? Well, number one, you have to understand the tools. As I touched upon earlier, while options trading is complex, there's a myriad of tools and interactive resources available to help both novice and advanced investors effectively use options and volatility strategies to manage risk and achieve their goals. And it's strategy, right? You got to learn the strategy. If you don't want to get beat in the market, you got to learn the strategy. It's like a video game. You have to learn your different abilities. If you don't, you're not going to be as good as you could be. Now, one of my most frequented and favorite online resources to use is the Options Institute at the Chicago Board of Options, or SIBO Exchange, which you can learn about if you like, along with all of these other strategies I'll be discussing on our Discord server linked in the description below. Now, 2, define risk limits. Before you make your first trade, understand what's at stake. You can lose 100% of your investment if you're playing long calls or long puts without any kind of underlying shares to hedge with. So if you're just playing the long call side, you must know your investment. You can lose all of it. Before you put real money at stake, understand the potential downside of your trade and establish the point where you'll exit the trade from both a standpoint of profit and loss. I see it all the time. People plan out their profits, but they never plan out their losses. When you enter into options trades with your eyes wide open and realistic expectations, you'll be better at managing your trades and, in turn, your risks. Number 3, be disciplined. Now that you've defined your risk limits, you must practice discipline. Why is this important? In the heat of the moment, when a trade has become better or worse than expected, it's very easy, and I see it all the time, especially in the group. No offense to anybody, it's just a human element. It happens to me too. It's easy to lose control of emotions and make decisions that are risky. How many times have you made a decision in the moment during trading and you've quickly come to regret it later because you were in the heat of the moment? It looked worse than it was. It happens. Now the difference is, you got to learn from it. Traders who are able to make level-headed decisions in the face of chaos are the ones who are able to preserve long-term capital gains and survive. That's one of the hardest things to learn. Number 4 is be focused. Be aware of factors that will affect your trade and monitor those conditions. Be aware of order flow in the products you trade. Factors such as supply and demand can affect the extrinsic value of options. It is also crucial for traders to monitor and interpret the news. Keyword interpret, not believe. Interpret the news and understand the difference between hype from reality. This is also crucial. And make appropriate decisions based upon your own personal risk parameters. Everyone's different. That is why retail trading in groups is a terrible idea. Everyone has different risk parameters. Now, be flexible. Not every trade will be a winner. What separates the winners from the losers is the ability to recognize a losing trade and cut losses by exiting the trade. It's hard to accept it at the moment, but you will learn from every mistake you make, hopefully. As in all areas of life, your ability to shake off adversity and move forward with a clear head will set you up for success in the future and for your next trade. And last but not least, learn the strategies. There's more than just going long on calls. Sometimes you have to play defense. Sometimes you have to play calendar spreads. Sometimes you have to play protective puts. Sometimes you need to play covered calls. There's a situation that calls for all of it, and there's money to be made in every situation. If you call the right option strategy during the right moment, you will see more profits because there's a lot of them. If you take some time to learn the strategies, you will understand what the strategy is right for you and for the current situation. We have an option strategy kiosk in our Discord that you're welcome to come and use at any time. I will be making videos on all these strategies one at a time to try to get people to understand just how much opportunity for strategy there is out there. Because once you can start thinking and utilizing strategy, you feel like you have a lot more control over the situation because you use the tools at your disposal available to you to manipulate the situation in your favor. That's it. You know, if you want to learn to trade, you got to do it right. Trading in groups is okay. You just got to make sure that the group itself is getting the information from the right places and is going about it the right way. So I hope this helped everybody. And again, I will get those individual strats out. Talk to y'all later.